Hello.
Hey, Mike,
How's it going?
can you hear me?
I can hear you just fine. And I
Hang
believe
on
we
one
are,
second. Figure out my audio and see.
yeah, and we're live right now. Um, Man, what a world we live in. I was on one Zoom call with about 50 people talking about the market, and I flip over to here to a live stream. Um, this we continually evolve and move towards a real time market.
Yeah, yeah, yeah. No, isn't technology grand, right?
Well, it's about the communication and it's about the quality of the communication. Some interesting things I think we just saw here in the last few days about communication. Elon Musk buying that big chunk of Twitter. He's bought almost 10% of Twitter. He's on the board of directors now. And the one thing you know about Elon Musk is he marches to the beat of his own drum.
It's his way of. Can you hear me? We all good communication wise?
Oh yeah, we're good.
Okay, good. Okay, yeah. No, he's thumbing his nose at the SEC. I'll show you. Let me get exposure in another big social media platform here.
Yeah, well, and I think he said that he likes the concept of Twitter. He's just is a little concerned about some of their editorial actions, I guess.
Yeah, you
Which,
don't get to pick and choose. So it's definitely. I'm a big fan of Elon Musk. Say what you will, but he's truly a modern day Thomas Edison or Henry Ford as far as revolutionizing any industry he gets involved with. It has profound impact, and that you look at, what he's done for the Ukraine as far as, Russia wanted to take out the internet infrastructure there and setting his satellites over that area and allowing free internet access for Ukrainians, all Ukrainians, military included, has been just a huge has been huge for allowing Ukraine to kind of survive and deal with Russia.
well, look, technology changes the landscape in ways that you can never really predict, um, but you have to be, thinking about the fact that what he's done in the Ukraine is similar to what mobile phones have done across the world. Prior to the mobile phones, you had to have a landline. It was a massive infrastructure project to actually wire to every house. So the poorer countries had a hard time having good communication. Then mobile comes in, you throw a tower up in the middle of town, and you can start selling mobile phones, and everybody can start communicating.
Yeah, no, it's pretty amazing. And I just read something today that Jeff Bezos is in the process of buying all these additional satellites now to have a competing internet, similar to what Elon Musk has with his satellite system. Jeff Bezos is doing something very similar with Amazon right now.
Yeah. So welcome back from your vacation. You know,
Yeah, it's good to be back. It's not, yeah, definitely. It's nice to have toes in the sand and get away from it all. And I don't think I missed that much last week from a cash standpoint, in that we're still in that. I'm not going to say free fall in SPF as much as just that settling out period to find, seeking value in the market right now. Where's fair market value? And I think the market seems to be in the process of trying to figure that out, with Southern Yellow Pine leading the charge to the downside first.
yeah, it's we've talked about this kind of over and over. There will be convergence at some point in time as you approach the expiration of a contract. There will be convergence, and it can happen in multiple ways. You can have, if futures is a discount, it's going to rise to cash, or cash is going to fall to futures. In this case, right now it appears as though the cash market is the one correcting down to the futures market.
Yeah, absolutely. And I just shared my screen. We can jump in here. And again, Mike, thanks for manning the post alone last week. I truly appreciate you doing that. But let me, okay, here, and I'll come back to these, but there's some good stuff here. But when you look at uh, here's 4-inch species comparison, and
Oh, we got
blue
to get
line
you.
is,
Hang on a second. Sorry.
can you see it?
There we go.
There you go. So blue line is futures, and you can see how, we talked about way back when how it made, little sense for southern yellow pine. Green line is eastern southern yellow pine. Why did southern yellow pine have this big premium to futures to the other species? And the day of reckoning is playing out right now, where you've had complete convergence of southern yellow pine into futures, but also into this bigger discount, massive discount when it comes to hem fir, Doug fir, and even to SPF, where I'm hearing pine numbers on 4-inch in the 900 to 850 area, on 6-inch in the sub 700 area. So, pine after making new highs, from last year has had this big collapsing structure back to reality, where we all thought this is where we would see the production come on first. These are the best EBITDA markets for sawmills, and that's playing out true to form now, with pine kind of leading the charge and calling out the other species finally, as far as you've had that convergence with pine into futures at this point.
And pine definitely has that seasonal move where the treaters need to get that wood in to get it treated to get it ready for the big push in the spring summer building season. Um, you kind of see that every year. Well, they probably finished that, and yeah, you're right. I'm looking at some southern yellow pine pricing on our platform right now. Um, 2x4 16s are 950, and what I find really amazing, 2x4 12s 850, 2x4 10 750.
Yeah, and so what I'm seeing, especially like with MSR type guys, and some of the builders that can swap species, obviously, the move back into pine is playing out at these dramatic discounts now, where I think just from what I'm seeing, kind of from a business standpoint, is there's definitely more interest in pine relative to the other species, and I think more so than coming off in these triple digit type numbers, I think now the counters you're starting to see in pine are somewhere in the $20 to $30 area, mill direct, where the big buckets of coming off in these bigger buckets is kind of, I think you're getting closer to some kind of tradable level in pine, at least for the time being. Which is a good thing, which shows that there's still demand, there's still underlying need out there. So, kind of going back to, I figure we'll start macro and then work our way down like we usually do. Um, the big takeaway, obviously, this pink purple line, I guess more pink, is 10-year continues to, we're in the 2.55% area. So you can see, the orange line is lumber. Lumber continues to stumble around. I think you're probably kind of, JP Morgan had something out yesterday. I'm sorry, not JP Morgan, or was it JP Morgan or Morgan? I'm trying to think. One of the big banks had something out yesterday where, kind of talking about this is the dead cat bounce. This is your bear market rally. So it'll be interesting to see if equities begin to roll over again, especially with crude kind of stabilizing and beginning to move back up. But, kind of more importantly here, look
That's
at this.
bump back there just a second. The VIX, which people probably don't know much about, I think is a really important um, indicator. So the VIX is the volatility index, which measures the premium that traders are placing on options on the S&P 500 futures contract. And right now it's slightly elevated. Historically it's under 20. It's at 24 right now,
Yeah.
but in massive, downswings, it's risen all the way to 60, 70, 80. Um, so I've actually really surprised by this. I thought the VIX would be a little bit higher. Um, what that tells me is that there isn't the fear that the equity market is going to crater.
Right.
I think that people are just willing to accept maybe flat to slightly down, but have zero fear about it just fully cratering.
Yeah, well, I mean, it's been a good place to be from a return on a return of equity or a return on equity, where it's been pretty consistent all along. And if you've been invested in equities since 2015, 2016, let's not kid ourselves. Whatever downside there is pretty minimal, and the upside potential is significantly greater. And I think until you break that kind of higher high, higher low structural, technical structural formation, it's tough to, as much as I can tell you what I believe, but the market is the market, and so far it's proven that equities are the best game in town. And until you prove otherwise, you have a whole generation of investors, really, that have come into investing after the 2007 2008 crash, where you think about when this market ultimately bottomed out. You've had a decade of higher highs, higher lows, where you have a whole generation out there that have never really known a bear market, and never had to experience a bear market structure. So we all know inevitably history repeats itself when it comes to equities, but right now, um, yeah, it's this has been the best game in town for sure.
Um, well, and the index, the people that create the indexes are pretty good about making sure they're always cycling out the bad stocks and cycling in the good ones. Um, but yeah, without a doubt, they. I'm just trying to. I want to pull up this. Oops, where'd you go? Here we go. I want to share my screen for just a second. I want to show you that VIX chart. Get it up here. Oh shoot! This is what happens when you work with only one screen.
Yeah, there you go.
So here's that VIX, and from a time horizon, what you can see is this is uh, February 10th of 2020. We all know what happened there. Actually, I remember basically where I was. Um, the VIX shot up to almost 60, and then of course came right back down, and then here we are last summer. Um, right at the October. Um, so this was the start of the invasion into Ukraine, and we've pulled back.
Yeah, I
So
think
look,
what's interesting is that if you look at that prior to 2020, you can kind of draw a trend channel, and it's interesting that the highs, if you just average out those highs prior to 2020, those are almost becoming the lows now, post pandemic, which just an elevated period of volatility. Even though
yep.
you're not back at these all-time highs, you're still at an elevated period of volatility, or at least that's what it tells me.
So yeah, I just want to make sure people understand what the VIX is. Keep an eye out for it. The VIX is really interesting stuff.
So we'll jump into interest rates here, and then work our way into lumber. But you can see this is again, and this is a great website. I highly recommend people, if you want any type of government information, you can get the raw data and dump it into SAS, Excel, but then you can also get them to chart it out for you. But Federal Reserve of St. Louis, has a treasure trove of information on anything economic with the U.S., any type of data from the beginning of time to current, with housing, with macro, micro type indicators. I highly recommend Fred. It's user friendly, and again, this is where the government dumps all their raw data into. But you can see this big spike up since the beginning of 2022 in the 30 year. And somebody had sent to me, this was on this guy named Len Kiefer had put this out, and I looked at his. He put all of his coding, all of his raw data, so all of his data works out. I back checked it. his coding, but you can see, this speaks for itself. U.S. mortgage rates up 1.5 percentage points, biggest increase this century. Okay, this century, you're going back to 2000, but that's still a pretty substantial move. And this next chart kind of shows, this goes back to 1990, but you can see these red, these are kind of like heat indexes. You have a 1.56% increase in 30-year mortgage rates for the month of March, which is just massive. I mean, we're used to interest rates trending down, these subtle ticks to the upside, but look at October, November, December, January, February, March. We've had this continuous trend to the upside where, again, you're seeing this felt, a massive increase back up into the 2018, 2019 highs. So you're just on the verge, the threshold of being back at 5%. Historically, we know that this is still relatively low, but when you come from an area of 2.5, 2.75%, and you basically are to the point where you're going to double that in a, basically in a year, just under a year and a half, that's a pretty substantial increase, knowing what the Fed has ahead of them as far as just going back to that 2.5 to 3% Fed funds rate. The reality is you're going to see a half a basis point increase this month and a half a basis point increase next month. And the market is building this in. When you look out at the yield curve, the further out you go, you're starting to see that inversion. You're starting to see markets build in a substantial increase in interest rates. That's what lies ahead.
And the move in interest rates really fascinates me right now, because in the last, call it 25 years, inflation is kept in check by technology. So if there was a pile of money sitting over in a corner, someone with some technology would come on and say, okay, I can make that whatever process system something more efficient, and I'll pick that money up. And that's what kept inflation in check. This time, the inflation is really coming from commodity prices, which we're experiencing here, of course, in lumber. Um, and there's really no technology that's going to take take care of a war in Eastern Europe. So, I think that to combat the increase in this commodity price, raw material price, the only answer is to slow down the economy. And you slow down the economy by making everything more expensive. And you make every dollar buy less.
Yeah, and so I think, and we'll jump forward here, but I think, so what does that mean? Anything that's capital intensive, money costs more, that same capital costs more money than it did 6 months ago, 3 months ago, a year ago. So these industries that are capital intensive, can you continue to grow at the same metrics? And that's the $1 million question, and that the Fed wants to believe that they can engineer a soft landing and slow growth without being recessionary. And there's very few playbooks to go back where you have this instance of inflation that, let's not kid ourselves, the Fed is responsible for helping to create a lot of this inflation. So it's going to be an interesting dynamic going back to equities with this idea that you can continue to plow ahead, higher highs, higher lows in an inflationary environment where you, by design, have to slow growth to help curb inflation. Again, that's a tall task. That's a lot on the Fed's plate here to engineer. And let's all hope. There's that word we hate to use when it comes to trading, but let's all hope the Fed can engineer this.
Yeah, for sure. All right, moving along.
Yeah. So weekly continuation. And I apologize, I used the wrong numbers here, but you can see basically we're into this 50% retracement on a weekly continuation basis. This is basically in the this 960, 970 area. This is May front month futures. 62% is going to put you somewhere in the 851 area. So if you break down underneath here, and I'll jump forward, I'll come back to this, but here's the May. You can see you've got this downward sloping channel. market's trying to bottom out here. Last week's low was in the 930 area. Underneath here, from a technical standpoint, the ideal situation in May would be to fill this gap at 920.70 and then truly bounce, get back above the 9-day, get back above the 100-day moving average. For me to be convinced that we've bottomed, you're going to get back above the 9-day. The 9-day is still downward sloping. It's in the probably in the $1,000 area. The 100 days back in this 1,025 area, 1,028 area. So you really need to say May get back above 1,000, back above 1,025 for me to be convinced that we've bottomed, to have any shot of going back up into this 1075 to 1,100 area. But at the very least, if you're trying to project where this thing could bottom, somewhere between here down into the 920, worst case scenario, you're going to go into this 62% retracement area, which would be an 850. And, of interest, okay, here's May, here's the price curve in futures. So May's all the way up here at 966. Here's July, September, November, January, March. You're getting compression in these back months. So when you look at July through January, February of next year, you only have a differential really of somewhere in that $40 to $60 area. So, the market sees value in this 850 to 800 area. So what does that mean for a cash market? Print is likely going to be, my guess is sub 1200, maybe in the 1170 area. Tonight, midweek by the end of this week, you've got May 966. So, you still have the constraints of logistical and transportation issues holding spot market prices up. But at the very least, the futures curve tells you that fair market value moving forward is somewhere in this mid 800 to 800 area, let's call it 860 to 800 area. And you're definitely seeing, we'll get in this later on, but you're definitely seeing open interest build in these back months where you're having a very difficult time making lower lows in July, September, November, where there's definite interest to forward buy for future need in these back months. And then let me see here.
Which
Uh,
that's the phrase that I hate to say, the new normal. Um,
right, right.
I
No, no, absolutely. And that's the tough part, is that historically, we know that these are still significantly high numbers, but what is new normal? And we know new normal isn't 350 to $400. So is it 500? Is it 700? Right now the market's telling us that the new normal is in this 850 to 800 area for the time being. And all I can say is there's risk in all of this. But if I'm going to own something, I want to own the cheapest wood out there. And futures and southern yellow pine are the cheapest wood out there. Fir, Doug fir, hem fir are the most expensive species out there. Orange line is, Western SPF, that's in the middle of nowhere. So if I could buy 1100, 1150 today in cash, what does that number mean? I don't know. If you need the wood, you have to buy it. But May is telling you that, okay, well, I can still buy 150 to $200 under where legitimately mills are probably taking some type of counter today on 2x4 4-inch.
Yeah, and speaking of new normal, inflation, the floor is definitely higher. The floor price is definitely higher. The producers have higher expenses. Like everything is more expensive today. So maybe these floors are above the traditional levels. By how much, I'm not sure. But these down markets like this are challenging because you're right. I'm running out of wood, but I don't want to buy it because it's going to be less expensive in 3 weeks. But I need it today. What do I do?
Yeah, and that probably sets up more of a scenario instead of seeing this panic buying, everybody running through the door all at once. Um, we obviously know that there's a lot of wood in the pipeline still trickling through to the end users. and people are watching futures come off, they're watching cash come off, they're watching southern yellow pine come off, to where, it could set up a scenario where it's just in time, knowing that in a falling market structure, I'm going to buy what I absolutely need to buy and then kick the can down the road. And in a week, 2 weeks, 3 weeks, I'll revisit it. And I will say that there probably would be more comfort in chasing this market, knowing that the market's bottom, than being the hero and trying to, catch a falling dagger here and pick a bottom, especially, like, again, May at 950 from a spread standpoint is still trading $100 over July. And then you've got cash trading $150 to $200 over that. Can anybody look at anybody else with a straight face and say that there's absolute value at 1100, at 1150 in Western SPF? The answer is no, because the other markets are saying that that's not where value is. But if you have to buy, then you have to buy.
Right.
That's the number you get.
But from a business standpoint, if you have the opportunity to make a profit buying at 1100 and shipping it this week because there's a hotel that's being built and it's going to need a bunch of wood, yeah, you know what? That you do what you have to do.
And I think that the bigger beneficiaries will be the truck-based type business, where if I can get trucks out of Canada, out of Western Canada, get trucks out of Eastern Canada, where it's going to hit my yard, hit my reload a lot sooner than those late shipping cars, then obviously those trucks are likely going to get, you're going to get the demand truck-based business first, because you're going to be able to tangibly hold that wood a lot faster than a rail car that's a month late shipping out of BC right now. From a basis standpoint, this is last week. May was trading at a $360 discount to cash. Fast forward, and again, this was as of yesterday's closing prices. May had narrowed again, going back. We were 360 in the last week. Cash has fallen $130 relative to May to narrow that. But again, you look at the average basis, we're still substantially higher. And look at last year, we were $84. So you still have this massive differential between cash, the premium in cash relative to futures. Fast forward to July, $480 a week ago. Again, July trading $480 under print into 338. So you're still getting that big narrowing. Same thing in September, 535 a week ago into 370. So, again, you're starting to, like you referenced earlier, Mike, you're starting to see that convergence play out with print, with cash, more so than futures continuing to free fall. You're starting to see the bigger chunk offs now in physical cash. May July spread. We talked about this for the last 3-4 weeks, that this abnormal differential 150, 175 over. This is a week ago. You were in the let's call it $140, $150 area. We've come into, basically, have had a 62% retracement. We've traded into the $85 area so far. 100 days down at 72. But again, what's the potential on this spread? Does it still belong at an $85 to $100 premium over July? And I'll jump back to, the answer is why. This still has a lot more potential, probably not now, but I think you're more likely to see bigger convergence, or the potential for bigger convergence between May and July. Maybe not necessarily now, but as you get into month end, why do all these months belong? You see, kind of this setting up, this convergence between July through March. Does May belong at this big premium? The answer is probably no. So again, fast forwarding back to the spread structure, I would still be careful assuming that this has to trade back out. I still think there's a lot of potential for this spread to collapse back in, especially with May trading at this big premium to July.
Yep, agreed.
Open interest wise, and I had somebody bring this up. There was confusion when we talk about the CME bulletin and then compare it to the CFTC numbers, and he brought up a great point that I just assumed everybody was aware of. The CME does not put out a bulletin. When they give this, so here's, you can see last week 2650, this week we're 2697. You would continue to see this build. When we look at this number, this is futures only. Underneath this, you've got all the calls and puts. And so you manually have to calculate these numbers. There's no bulletin that shows futures and options combined from a total open interest standpoint. You manually have to add the options in for calls and puts in all the different months. So when we reference this number, this is futures only. When we jump into the CFTC commitment of trader numbers, we're looking at options, futures, and options combined. So again, it's kind of like an apples to orange comparison with the bulletin. But when we look at the CFTC commitment of trader numbers, it's including options. And I think options are important because a lot of commercials, a lot of institutional players obviously use options. They need to be included in these numbers. But I thought that was a great point. When we reference the CME bulletin, we're just referencing futures only. When we look at the CFTC commitment of traders number, this is futures and options combined. So again, going back to this bulletin, if you add up futures and then all these options, it's going to equate to this number here, which is total open interest futures and options combined.
Got it. Okay.
So again, you're seeing the continued light liquidation. Again, if we remember, this managed money was up over 700 at one point. It's down to 300. But the number that jumps out to me is this non-reportable position. Look at the longs versus the shorts. What's the staying power of these longs here and here? Okay. A lot of this is, a lot of this is, so these other reportables, a lot of this is the home builder segment. People have asked me, what's this other reportable position? It's people that don't necessarily, that trade greater than 20 contracts, but don't necessarily get categorized as a producer, swap dealer, or managed money. So they might see themselves as a home builder or somebody, a private equity, a developer type that has a vested interest outside of just speculation. This could also be somebody that sees themselves as a speculator, but not necessarily as a money manager. So when I look at this, these guys are still net long here, 401 to 320. This is probably more industry related. There's a need, there's a reason. This number here, 813 to 550, this number, the differential here in a falling market, what's the staying power of this excess long position here? This could be your next cannon fodder as far as getting washed out. If, how could this market break down to that 62% retracement, the 850 area? This would be the group that I would watch here, because if these guys get margin called out, that could be the catalyst to break through that 920, 900 area and get another flush down in futures, because you do have this net long position that's probably not industry related. This is more speculative, is my guess.
And that's traditionally we call them the fast money.
Yep.
They're fast to get in, fast to get out. And I agree that that could be the next the powder keg to go.
And so with this discount in futures, when you look at the producer merchant segment, this number will gradually increase because there's a vested interest to get long at this discount to cash. This number is likely to decrease because I don't need the short. This disconnect under physical cash. As I sell my cash, I release my future shorts. So these numbers are likely to converge on each other. Again, the number, okay, this will probably continue to fall, but it'll fall to a point. Again, these are the numbers. This is the really big number to watch, where you could get the equalization here, where there probably could be another 300 to 250 contracts that could get blown up if this market doesn't stabilize.
All right. What?
And then the last thing I wanted to run through, I know we're up again, rail car stats. Okay, the rail situation is, I'm not going to say dramatically improving, but you're seeing a substantial improvement week over week over week, where you're normalizing relative to where you should be over the past 2 years. And you can see this is Canada. Again, you're still upward trending. You're not anywhere near where you were 2 years ago, but you're at least making headway, some progress. And then this is the U.S., where you're kind of back in the middle of the previous 2 years. And that was it, Mike. Again, all my plug here. We're doing a risk management seminar at the end of this month. We've got about I think somewhere around 20 guys signed up, all facets of the industry. So if there's any interest, please reach out. You will get your PhD in risk management. So anybody that's got interest, please reach out and contact us.
Perfect. Well, I think the overall theme here kind of feels a little bearish, um, because we're looking at past data. But you know what? The reality is we could be stabilizing here. We've had several days of kind of, in recent terms, low volatility. We haven't gone limit in a few days here, which is
Yeah, yeah,
something kind of new. There's an old adage out there: never sell a sleepy market. And I look at today and yesterday were both really low volume, kind of sleepy days. Um, I think the futures market has done its move and said this seems to be where we're forecasting prices to be, and it feels like it's just waiting for the cash market to come to it. I'm seeing the cash market pull off, just in the prices that we're seeing on our platform. So I think we might be in just a little bit of a boring sort of stable time period here.
which isn't
Um,
necessarily a bad thing. You don't need to race around and $300 trading ranges every week. It's okay for the market to catch its breath. With the upcoming shows you guys have this week between you and Ashley, it'll be interesting. The one thing I'm seeing with my book of business, my customer base, is I'm not seeing a build of inventory in the secondaries where wood comes in, it immediately flows out, where there's not that obvious build where, okay, once you start to see end user inventory build, there's a bigger sign of a slowdown. So it'll be interesting to see what the other guys have to say later this week as far as, are they seeing that build? We know the mills have built the finished goods inventory at the sawmill level, but I'm not seeing it anywhere else. So I'd love to get their analysis on what they're seeing.
yeah, and prices move higher when the industry overall is building inventory and consuming. Consuming and building inventory will drive prices higher. Prices will move lower when the inventories are being liquidated. We're seeing that in our platform. We're seeing inventories coming out of warehouses, coming from non traditional players that wouldn't normally have an inventory. So, yeah, I think that there was a lot of protection put in, not just through futures, but through buying and holding of the cash market. Uh, hey, we're in Q2. Q1's in the books. Forget about it. We're into
Yeah.
Q2. Maybe that wood they put in during Q1 to use during Q2. The buying of that wood drove prices higher. Now we're going to consume that wood. So,
Yeah, yeah, no, and I think the other thing I'll throw out there to people, and I know a lot of people watch this the recording later on, but the other thing I'm not seeing, there's a massive backlog of existing business that's not interest rate sensitive, so it'll be interesting to see at what point do you work through that backlog. This is the end user backlog. What point do you work through that backlog and the new business dries up? But I'm still seeing everybody going strong from a demand standpoint with that business, that pre-existing business on the books is not interest rate sensitive. And I'm not seeing signs of, it'll be interesting to see when those signs show up. We all know the headwinds that are out there facing housing, but it'll be interesting to see where it actually starts to show up within the different user segments within the industry.
Right. And we know people aren't building inventory because futures is at a discount. You buy what's cheap. If you want to buy wood for the third quarter, you're going to forward price that somehow.
Yep.
Um, and then the thing I'm looking for, Greg, though, is the repair and remodel numbers, where those numbers are more, I don't want to say interest rate sensitive, but definitely more inflation sensitive.
So
If
I will say, Mike, with some of the sawmills that I deal with that have that big box direct exposure, you're definitely starting to see a slowdown over the last 2.5 weeks, where the big box component is definitely seeing a slowdown. The interest rate sensitivity, high prices, where you're not going to replicate, you're not going to mimic what you did a year ago, and I don't think anybody expected that. But it'll be interesting to see, do you fall under historical type averages leading into US Memorial Day? We all know that's the kickoff, that's kind of the big build between now and to US Memorial Day in anticipation of that rehab renovation component, the weekend warrior component. Initial take over the last couple of weeks is, that's the one negative out there, is you're definitely starting to see a slowdown with big box consumption.
and that's a hard number to measure. So you've got an interesting insight. We got to look at when Home Depot and Lowe's put their numbers out. See what if you dive deep into their quarterly reports, you might be able to figure something out. Uh,
Yep. Yep.
um, but all right, let's wrap it up. That's a great call, Greg. Welcome back. We'll see what happens over the next week or so. But the word of caution from me is that make sure you separate your brain of futures and cash, because they're very separated right now. And you could find cash being in a very bearish market and futures sitting there doing nothing, and that would frustrate you.
Absolutely, absolutely. And again, the last thing I'll leave people with is that just because you see the numbers developing in futures, just because you hear somebody took this number, what's the reality of most people actually buying those numbers? You need that 30 to 45-day window, that work through the trickle down effect to get to the end users. So just because you're hearing some extreme low numbers in cash, whether it's SPF or Southern Yellow Pine, doesn't necessarily mean you're going to see that reflected if you're going to buy from your contractor, your local yard, where they're still trying to sell those higher numbers, and it takes time for that to work its way down through the food chain.
Absolutely. All right, everyone. Have a safe week, and we'll talk to you next Tuesday.
Thanks a lot, Mike. Thanks, everybody.
Bye.
Take care.